Investing can seem like a daunting maze, especially for beginners. The sheer number of options and the complexity of financial jargon can be overwhelming. But what if I told you there's a simplified way to participate in the stock market's growth potential? A method that doesn't require you to be an expert in picking individual stocks. Enter equity mutual funds, your gateway to building wealth over time. These funds are designed to make investing accessible and manageable for everyone. Imagine a basket carefully curated with stocks from various companies, reflecting a particular investment strategy. Each stock represents a different company, adding to the diversity. That's essentially what an equity mutual fund is. It's a collection of stocks chosen to meet specific investment goals. Instead of purchasing individual stocks, you buy units of this diversified basket. This means your investment is spread across multiple companies. This approach allows you to tap into the collective growth of multiple companies. As these companies grow, so does the value of your investment. It's like owning a slice of the entire pie rather than just a single piece. This diversification helps in balancing the risk and reward. Whether you're aiming for long-term wealth creation or seeking to achieve specific financial goals, equity mutual funds offer a strategic avenue to navigate the exciting world of investments. They provide a structured way to grow your money. By pooling money from multiple investors, equity mutual funds empower you to invest in a diversified portfolio of stocks, even with a smaller investment amount. This collective investment power is one of the key benefits. This approach not only spreads your risk, but also provides access to professional fund management. Experts manage the fund, making informed decisions on your behalf. Let's delve deeper into the world of equity mutual funds and uncover how they can help you achieve your financial aspirations. From understanding the basics to exploring advanced strategies, there's a lot to learn and gain. Equity mutual funds offer a compelling investment avenue for both seasoned and novice investors. One of the most significant advantages lies in diversification. By investing in a variety of stocks across different sectors, you mitigate the risk associated with putting all your eggs in one basket. Furthermore, equity mutual funds provide access to professional fund management. These experts conduct thorough research, analyze market trends, and make informed investment decisions on your behalf. This expertise proves particularly valuable for individuals who may not possess the time or knowledge to navigate the complexities of the stock market independently. Equity mutual funds also hold the potential for high returns over the long term. As companies grow and their stock prices appreciate, the value of your mutual fund units tends to rise as well. While past performance is not indicative of future returns, historical data suggests that equity investments have the potential to outperform other asset classes over extended periods. Before embarking on your equity mutual fund investment journey, it's crucial to familiarize yourself with some key terms. Understanding these terms will not only help you make informed decisions, but also enhance your confidence as an investor. Net asset value, NAV, represents the per-unit value of a mutual fund scheme. It is a fundamental metric that helps you gauge the performance of your investment. It's calculated by dividing the total value of the fund's assets by the total number of units outstanding. This calculation is typically done at the end of each trading day. The expense ratio reflects the annual fee charged by the fund house for managing your investment. This fee is crucial as it directly impacts your net returns. It's expressed as a percentage of your investment and covers administrative, management, and other operational costs. These costs can include everything from marketing expenses to legal fees. A lower expense ratio translates to higher returns for you. Therefore, it's always beneficial to compare the expense ratios of different funds before making an investment. Assets under management, AUM, refers to the total market value of assets managed by a particular mutual fund scheme. It is an indicator of the fund's size and success. A higher AUM often indicates investor confidence and can reflect the fund's track record. However, it's also important to consider other factors like fund performance and management quality. Systematic investment plan. SAP, is an investment method that allows you to invest a fixed amount at regular intervals, such as monthly or quarterly. This disciplined approach can help you build a substantial corpus over time. SIPs offer the benefit of rupee cost averaging, which helps you average out your purchase price over time, reducing the impact of market volatility on your investments. This strategy can be particularly effective in volatile markets, providing a smoother investment journey. Section 4. SBI Blue Chip Fund, a case study. Let's illustrate the concept of equity mutual fund investing with a real-time example from the Indian stock market. SBI Blue Chip Fund. This fund primarily invests in large-cap companies, which are well-established entities with a strong market presence. From a technical analysis perspective, you would examine the fund's price movements, trading volumes, and chart patterns to identify potential entry and exit points. Fundamental analysis, on the other hand, would involve evaluating the financial health of the companies within the fund's portfolio. This includes scrutinizing their revenue growth, profitability, debt levels, and management quality. By combining both technical and fundamental analysis, you can gain a comprehensive understanding of the fund's potential and make well-informed investment decisions. Remember, past performance is not a guarantee of future returns, and it's essential to conduct thorough research and consult with a financial advisor before making any investment decisions. Section 5. Navigating your equity mutual fund investment journey. Investing in equity mutual funds is a relatively straightforward process, but it requires careful planning and informed decision-making. First and foremost, conduct thorough research to identify funds that align with your investment goals, risk appetite, and time horizon. This step is crucial as it sets the foundation for your investment journey. Consider factors such as the fund's investment objective, historical performance, expense ratio, and fund manager's track record. These elements will help you gauge the potential returns and risks associated with each fund. Next, choose an investment mode that suits your preferences and financial situation. You can opt for a lump sum investment, where you invest a significant amount at once, or a SIP, which allows you to invest smaller amounts regularly. SIPs are particularly beneficial for those who prefer a disciplined approach to investing. Once you've selected your preferred funds and investment mode, open an account with a reputable mutual fund distributor or directly with the fund house. This step involves some paperwork but is generally straightforward. You'll need to complete the necessary KYC, or Know Your Customer, formalities, which typically involve providing your identity and address proof. This is a mandatory step to ensure the security and legality of your investments. After setting up your account, you can start investing in your chosen equity mutual funds. Make sure to review the transaction details carefully before confirming. It's crucial to monitor your investments regularly, track their performance, and make adjustments to your portfolio as needed. Regular reviews will help you stay aligned with your financial goals and adapt to market changes. Section 6. Technical analysis for informed decisions. Technical analysis plays a crucial role in identifying opportune entry and exit points for your equity mutual fund investments. By studying historical price charts, trading volumes, and other market data, you can gain insights into potential future price movements. One popular technical indicator is the moving average, which smooths out price fluctuations over a specific period, revealing the underlying trend. Another widely used tool is the Relative Strength Index, or RSI, which measures the magnitude of recent price changes to evaluate overbought or oversold conditions. Chart patterns such as head and shoulders, double tops, and triangles can also provide valuable clues about potential trend reversals. It's essential to note that technical analysis is not foolproof and should be used in conjunction with other forms of analysis, such as fundamental analysis. By combining technical indicators, chart patterns, and market sentiment, you can enhance your decision-making process and potentially identify favorable entry and exit points for your equity mutual fund investments. Section 7, Mirai Asset, Emerging Blue Chip Fund, a deep dive. Let's explore another compelling investment option in the Indian equity mutual fund space. Mirai Asset Emerging Blue Chip Fund. This fund focuses on investing in mid-cap companies, which are considered to be at a relatively nascent stage of growth, but hold the potential to become future blue-chip companies. From a technical standpoint, you would analyze the fund's price movements, trading volumes, and chart patterns to identify potential entry and exit points. Fundamental analysis, on the other hand, would involve evaluating the financial health and growth prospects of the mid-cap companies within the fund's portfolio. Consider factors such as revenue growth, profitability margins, debt levels, management quality, and industry outlook. By conducting a comprehensive analysis, you can assess the fund's potential for long-term capital appreciation.